What's going on, guys? Welcome back to the channel. My name is Mark and this is 360 Finance. So first off, hope you guys all had a fantastic Canada Day or July 4th, which is today. I know I did, and I went to Montreal to watch the Stanley Cup Finals. Unfortunately, the Habs could not get it done. Now down 3-0, likely going to get swept in the Stanley Cup Finals. Cheers. Anyways, what I want to showcase in today's video is actually my worst investment of 2021, and I want to use this video as a tool to not only self-scout myself, but teach other investors about these mistakes and why you should be avoiding them, and what trap I basically fell into here. And it's very, very simple. Not to say that I'm a terrible investor, but just to basically say that I'm human. People make mistakes. And if you do want to be a successful, disciplined investor, this is something that you should avoid. And unfortunately, I fell into the trap this year. So without further ado, let's go ahead and jump into the video. So Coinbase. Coinbase is my absolute worst investment of 2021. And basically what happened here is, as you all know, cryptocurrencies have becoming extremely popular in the past few years, past few months. Really, Bitcoin has surged this year in 2020 as well, as a lot of people have moved away from holding their assets in banks. They're moving to crypto exchanges or owning crypto in general, just because of the high inflation that's potentially coming here due to all the money printing that the governments worldwide are doing. People are basically buying into this thesis that they prefer to decentralize currency rather than have the banks and government police it basically and decide when to pour money into the economy and when not to. Okay, so anyways, that's just a quick synopsis on crypto. Coinbase is actually a company which you can trade crypto. Okay, so it's not an actual cryptocurrency. It's simply a cryptocurrency exchange. And essentially how they make their money is through trading fees from retail investors. And there is a institutional segment as well, but majority of their revenue does come from the retail segment. Okay, so basically this company IPO'd this year on April 13th, 2021, kind of at the height of Bitcoin. If you look at the price of Bitcoin, it was literally trading near its peak when Coinbase IPO'd, which was absolutely perfect timing by the company, I guess, because a bunch of them sold off on the day of the IPO. I mean, there's just a red flag right there that all of management is selling off almost 100% of their shares. I believe the CFO sold 100% of his shares on the date of the IPO. I mean, red flag instantly, right? Now, not all of senior management sold all their shares, but that's clearly a red flag when day one this company is going public that all of management is selling their shares. That should have been something that I clued in on. Basically, I just want to talk about what happened and why I bought this company. I bought this company really, I think, because of FOMO, the fear of missing out, and as people were making thousands and thousands of percent on their cryptocurrency investments, I kind of wanted a little bit of exposure to this market, and I thought that Coinbase would be a good company to do that with, just because they're not an actual cryptocurrency. They simply make trading fees off of people trading cryptocurrency, and as interest in crypto is basically at its highest it's ever been, I bought it at the highest that the stock has ever been. Now, it's only been a few months, and what you see with IPOs typically is a lot of volatility, and I am still holding the stock, but I only own one share. Okay, so I only bought one share, so it's not like a big deal that I've lost 30% of my position in Coinbase, but it's a lesson learned in terms of the fear of missing out and trying to stay disciplined and detach yourself emotionally from the market. I brought up an interesting article here called from Forbes that investors don't succumb to the fear of missing out, and it talks about this guy, and he talks about comparing the current situation to 1999, which was obviously the tech bubble, and a lot of people have compared our current market to the tech bubble. I've seen it everywhere online, and people just seem to talk about like the emergence of tech, some of the unprofitable companies that are basically skyrocketing in value. Palantir might be a good candidate for that one. Basically, they have a negative net income, but they're worth something like $50 billion at this point in terms of total market cap. And this article just talks about what it was like back then, and when your barber, your shoe cleaner, your neighbor, your friend are all talking about stocks. There's probably it's probably signaling that the market might be a little bit overheated, okay? Investing usually isn't a super popular topic for people. People usually find it pretty boring. All that they care about is making money, right? And when you're running into people all over the place that are talking about the stock market, it's potentially a sign, potentially, I'm just saying potentially. I'm not saying that the market is going to crash or anything here, but just potentially that we may be due for a bit of a correction. And if you actually look at the Shiller PE ratio, it's the highest it's ever been since the tech bubble, of course. And in 1999, it peaked at 44, and we're currently sitting at 38. Okay, so the Shiller PE ratio is just an aggregate of the PE ratios on the stock market, essentially. I don't know the exact companies that it pulls from, but I believe has something to do with the S&P 500. Okay, yeah, so you can see here, look at the yearly earnings of the S&P 500 for each of the past 10 years. So that's basically where the Shiller PE ratio comes from. And there was also an interesting clip from Warren Buffett's Berkshire Hathaway meeting a few weeks ago. I won't put the clip up, but maybe I'll put a screenshot of the graphic that he showed, which was the top 20 companies in the world currently, and then the top 20 companies in the world in 1989, and the drastic difference between those two. And his point was essentially that right now the top 6 companies, or 5 of the top 6 companies in the world are in the US. And if you look back 30 years ago to 1989, 30 years plus, majority of them were actually Japanese, and the Japanese stock market had a massive run-up in the 80s. And just like the US stock market has had a massive run-up since 2008, or really just since the 80s as well, since the 90s. There was 2 crashes since then, but essentially what I'm saying here is don't succumb to the pressure. Just because your friends are making money on crypto, just because your friends are making money on REITs, just because your barber's making money in the stock market, doesn't mean you should follow their advice. You should stick to a disciplined strategy over time, which is essentially where I made the mistake. I succumbed to FOMO, and I bought a Coinbase, which was essentially a terrible buy at the time. Management was selling. Bitcoin was at an all-time high. Interest in cryptocurrency was at an all-time high, and I succumbed to the FOMO. I bought at all-time highs, and I've lost 30% of my position. So I still own the stock because I do expect volatility, and hopefully I'll be able to battle back and get some of that position back. But we'll see over time. Ultimately, it's about the fundamentals of the business, and I bought it when it was valued at over 100 billion, and that's basically been cut in half since the date of the IPO. So this video, if you are new to investing, or if you've recently come into the market, you just started managing your own money for the first time, what this video should teach you is that you should not succumb to FOMO. You really should always have your own disciplined strategy that you need to stick to. And this all comes back to Warren Buffett advice about being greedy when others are fearful, and fearful when others are greedy. You don't need to do anything when people are making all this money. You just need to stick to your strategy. So instead of following the crowd, you should rebalance and take gains on the stocks that which you have run up, and maybe put your money in laggards or uncorrelated assets which haven't seen the massive run-up that some of these other assets have seen this year, as you'll probably benefit from a diversification standpoint and potentially get some run-ups on stocks which haven't ran up this year. You can look at international stocks, non-correlated assets, stuff that has been laggards essentially this year, but are good fundamental companies, okay? And if you look at my past video on waste management, there's kind of a reason why I bought waste management in January. It's because tech had this massive run-up last year, and I wanted to move into safer, more non-cyclical assets. And of course, I bought a few shares of waste management, and that's been my best investment of 2021. But my worst investment of 2021 was Coinbase, and I was going to go through the Q1 call letter here and such, but I think we've touched enough on this video. Really, the moral of this video: don't succumb to FOMO. It's I did, and look what happened. I lost 30+% of my investment, and it wasn't worth it, right? I should stick to my disciplined dividend growth investing strategy. Avoid these high flyer names because I got burned, and I don't want to see anybody else get burned, okay? So that's pretty much all I have for today's video. I hope you guys did enjoy. If you did, don't forget to smash the like button, subscribe to the channel, and I'll see you guys in the next one. Peace!